Before deciding whether Sam Altman was a visionary or simply well-timed, look at what management was actually optimizing for. San Francisco, 2023 into 2024. OpenAI went from celebrated lab to roughly $90 billion private company in about 18 months. That kind of leap rarely comes from brilliance alone. Altman was the public face, Greg Brockman the builder at his side, Ilya Sutskever the technical conscience in the room, and Satya Nadella the strategic partner with the balance sheet that mattered. On the legal page, OpenAI remained an odd creature. Nonprofit control sat over a profit-seeking operating structure. That structure mattered more than the slogans. A normal venture-backed company follows the cap table. OpenAI followed mission language, bespoke governance, and commercial urgency all at once. I have sat with structures like this before. They work beautifully until power, money, and timing stopped pointing in the same direction. The setup began in late 2022, when ChatGPT reached mass adoption faster than almost any software product in memory. Demand arrived before the organization had ordinary corporate plumbing. Revenue moved sharply upward. Compute costs did too. Every board packet in that period would have had the same red circle around infrastructure expense. By early 2023, Microsoft had already committed a multi-year investment, reported around $10 billion, largely through a mix of cash and cloud credits. That was not decorative capital. It solved distribution, compute, and credibility in one stroke. Some deals are written on the way to the office. This was one of them. The market context helped. Public software multiples were shaky after the 2022 reset. But artificial intelligence carried scarcity value. Investors were not buying current margin. They were buying position in a future computing layer. The price is the easy number. The price is never the deal. Then came the valuation mechanics. In spring 2023, secondary discussions and employee liquidity conversations began to imply values around the high 20s. By early 2024, tender discussions pointed near $80 billion. Fresh financing reports pushed the figure toward $90 billion and beyond. No ordinary discounted cash flow produces that number cleanly. The market was underwriting three things instead: extraordinary revenue growth, winner-take-most platform optionality, and strategic dependence from enterprise buyers. In private markets, those ingredients compress the discount rate faster than any banker likes to admit over the closing dinner. There was another mechanism at work. OpenAI kept extending the frontier narrative through product releases, enterprise deals, model upgrades, and developer demand. Each milestone reduced the sense of scientific uncertainty while preserving commercial scarcity. That is how a private round is priced, like a public momentum stock, with fewer quarterly inconveniences. Employee tender offers added their own discipline. Liquidity events told current staff that paper wealth might become actual money without a near-term IPO. That steadies retention in an expensive talent war. It also creates a benchmark in the market. Once a tender clears at a level, the next round rarely travels backward gracefully. Then, the whole thing nearly blew up in November 2023. Altman was fired by the nonprofit board, with language so thin it would have embarrassed a second-rate takeover defense memo. The market did not need many board minutes to grasp the issue. Governance had collided with commercial reality at highway speed. The room knew before the press knew. Microsoft moved quickly, offering Altman and Brockman a landing place, while OpenAI employees revolted and threatened to follow. A board can survive bad headlines. It cannot survive losing the operating company in all but legal form. By the end of that weekend, the board's leverage had evaporated. Altman returned within days. Several directors departed. Governance was revised, though not simplified enough for my taste. That episode did something investors usually appreciate. It answered the control question. The market learned that, whoever wrote the charter, the commercial ecosystem wanted Altman at the center of the asset. The aftermath was swift. Enterprise customers interpreted the reinstatement as stabilization. Partners saw continuity. Employees saw their equity story preserved. Investors saw a founder-like operator who had survived a palace coup and emerged stronger. In capital markets, survival itself can reprice the multiple. OpenAI's reported annualized revenue moved from the low hundreds of millions into the billions in unusually short order. The exact figures shifted by report and month, but the trajectory was unmistakable. With growth like that, buyers stopped asking whether the company was expensive. They asked whether access would still be available. By the 2024 financing cycle, the company was being treated less like a single product vendor and more like critical infrastructure for models, tools, enterprise copilots, and developer workflows. Once that frame takes hold, valuation begins to borrow from cloud platforms, chip leaders, and operating systems all at once. I have seen versions of this pattern before. Google, in the early 2000s, turned search dominance into an argument for owning the gateway to the web. The market paid ahead for control of a layer. It looked rich until the layer proved foundational. There is another parallel. Amazon Web Services in the 2010s moved from internal capability to rented infrastructure for everyone else's ambition. Once customers built on top of it, switching costs and strategic dependence did the heavy lifting. OpenAI is trying to become that kind of layer for cognition. What 30 years in the room taught me is simple. Founder mythology matters less than financing sequence, distribution leverage, and who controls the bottleneck. Altman scored well because he kept all three moving together after a governance rupture that would have finished a less connected operator. I have seen this before. When a company becomes the access point to a new layer of computing, capital forgives mess, boards retreat, and valuation runs ahead of accounting. Who's running the same playbook today?